Now that we have a fundamental understanding of how the exchange rate is determined, we now need to look at 5 different factors that is going to affect or influence the exchange rate. And the 5 that we look at is the demand for exports and imports, relative interest rates, capital flows, terms of trade, and also relative rates of inflation. Now, the common theme with all of these factors is that it is going to always change the demand and supply for the AUD. And so if the demand for Australian exports is going up, that means that other countries need to purchase our currency more. And that's going to push up demand for the AUD and therefore causing a shift right in the exchange rate, which is going to ultimately cause an appreciation. Now, for imports, if we are increasing our demand for international imports, we are technically supplying more AUD into the foreign exchange market in order for us to purchase those international goods and services. And so what we see is that the supply curve is going to shift to the right, depreciating the AUD. And so you can flip that and think, what would happen if exports is going to decrease? Well, the demand curve is going to shift left, thereby creating a depreciation of the AUD. And if we are purchasing imports less, that means we are supplying the AUD less, shifting the supply curve left, and therefore the AUD is actually going to appreciate. And for the factor regarding interest rates, if Australia is offering higher interest rates, it's actually more attractive for foreign investors. Because what that means is that if they decide to invest in us and our interest rates maybe have gone from 5% to 7%, it means that investors are now earning an additional 2% profit on their investments. And so if they want to make those investments, they need to first purchase our currency, which is then going to demand the AUD upwards and cause an appreciation. And the reverse would occur if it was lower. If our interest rates were low, it means that investors' returns would be lower, and therefore they would want our currency less because they'd just rather invest somewhere else. And the same logic applies for capital flows. If there's a brand new company in Australia and it looks like a very profitable project, then other countries are going to want to put funds into there. And this could be in the way of purchasing shares or equity, for example. And to do that, they need our AUD, which is going to push up, which is therefore going to appreciate the Australian dollar. Now, the terms of trade is particularly difficult to understand. And what you need to remember is that the terms of trade is a historical measurement. And so recall that if the terms of trade is favorable, that means that the export prices have risen relatively higher than imports. And so if the price of exports have gone up, it means that for a same given quantity or volume of exports sold, other foreigners have had to convert more of their currency in order to purchase the Australian dollar. And because there's a higher demand for it, it is going to put upward pressure on the exchange rate, causing an appreciation. An easy way of thinking about it is if you go back to the terms of trade videos, what we saw is that if export prices gone up, mathematically, more AUD was required to make that same purchase, and because people needed to buy more of it, it is also going to cause an appreciation. Now, if it's favorable as well, it could also mean that import prices have decreased, meaning that we are using less of our AUD to purchase the same quantity of imports. And if import prices are cheaper, that means that we're supplying less of our currency into the foreign exchange market. And so we're going to see a shift left in the supply curve, causing an appreciation as well. And so the opposite is true, that if the terms of trade is unfavorable, then it indicates that people are purchasing less of our AUD because they needed less to make the same amount of volume purchases. And if it was unfavorable due to higher import prices, which means that we've supplied more of our currency into the foreign exchange market, which is also going to cause a depreciation. So in summary, favorable terms of trade equals appreciation. Unfavorable terms of trade will mean a depreciation. Now, the other factor is going to be the relative rates of inflation. And this one's quite simple because you're thinking about the final prices of goods and services. And so if Australia is experiencing high levels of inflation, then people are not going to be purchasing our products more because it's now relatively more expensive. And so if people want our products less, that is going to cause a depreciation in the AUD because there is a lower demand. And so the opposite is true, that if our inflation levels were low, then our goods and services may look relatively cheaper. And so people are purchasing more currency to purchase our goods and services, which is going to cause an appreciation in the AUD. So this concludes the video. Hopefully the first 2 videos give you a better understanding of how the exchange rate works and what are the different factors that affect the exchange rate. In the next video, we're looking at how it's going to affect the current account balance, macroeconomic goals, and also living standards.